The next mental model we're going to talk about is called the availability bias. This is a bias that stems from our inability to remember historical events accurately. It says that 1. We often misjudge the frequency and magnitude of events that have happened more recently. 2. This happens in part because of our limitations on memory. And 3. We remember things better when they arrive in a vivid narrative. For example, a person whose home has fallen in value and is struggling to find a job is less likely to see or feel an economic recovery, even when the data shows that a recovery is in fact taking place. Conversely, someone who just landed a great job with an impressive salary is going to think that all is right with the world. They're going to be more inclined to see that as proof the economy is recovering. This concept is also a great example of what Danny Kahneman calls what you see is all there is. This is the notion that we quickly form impressions and judgments based on the information that is available to us at the time. For instance, we form impressions about people within a few seconds of meeting them. And in a similar way, we probably form an impression about a stock just as soon as we've seen its stock chart. Overall, the availability bias tells us that it takes a lot more mental effort to remember things that do not come with a vivid story attached. And this has huge implications to financial trading and investing. For example, a vivid memory of a financial crash or bubble might cause you to overestimate the probability of another one happening in the near future. Excessive media coverage and sensationalist journalism might cause you to assign the wrong probabilities to future events, as they stick very firmly in the memory. Only remembering your winning trades might cause you to overestimate your own trading ability. Because you only remember your last few trades, that might cause you to misjudge the true performance of your trading strategy. And this might cause you to discard or embrace a trading strategy too early. So here are some potential solutions to overcoming the availability bias. First, investors must understand the limitations on memory and see the difference between research and reaction. Before making any large changes, go deeper into the data and the past to make sure you're not overreacting. It's often better to choose unpopular versus popular methods, since popular methods will be based on common mistakes and biases. Most importantly, historical analysis and keeping a trading journal will give you the statistics related to your own trading and investment decisions. Studying this information will give you real insights, and this will allow you to trade scientifically without being influenced by the availability bias. For example, if you have the data available for all of your trades, you'll be in a better position to analyze which trades are working and whether your newly adopted strategy is really any better than your old one.